Today I would like to analyze Pinterest. It's a platform where you can share pictures to certain topics and also get inspiration. So we can see here in the 5-year chart we are up 32%, but in the 1-year charts we are down 16%, and in 6 months we are down 25%. So we're going to take a look at the financials to find out if this company is undervalued right now. The first thing we can recognize about this company is a market cap of 20.54 billion US dollar. This is when we take the current stock price multiplied with the shares outstanding. So in my opinion, it's already a huge company. Of course, compared to other companies like Meta, it's still very small. We can also see the dividend is not existing. We don't have a dividend. And the first one we are looking for in the financial foundation is the revenue growth. We would like to see that grow in the last 5 years. We want to invest in a growing business. We can see here in 2019 it was around 1.14 billion. Then we have a 48% growth, 52% growth again, 8% and 9%. So the revenue growth look really good actually. It's a check here. The next thing we are looking for is free cash flow growth in the last 5 years. This is also very important because the free cash flow can be used to invest in the business, to pay the dividend, or to buy back their own shares, or to pay the debt. So we would like to see that grow. And we can see here in 2019, it was negative around 34 million. Then it became positive. Then we had a strong free cash flow in 2021, around 743. Then we have the decline, and then we have the growth again in 2023. So overall, it's looking good actually. They become positive and they have a good free cash flow growth in the last 5 years. So it's a check here. The next thing we are looking for is free cash flow yield over 4%. This is very important because it also tells us about the valuation of this company. And what we're going to do now is we're going to take the free cash flow in 2023, 604.9. Then we're going to divide it with the market cap of 20.54. Okay. So then we're going to get the free cash flow yield. Okay, so the number we get is 0.0294, which means around 2.94%, which is under 4%. It's not great number, but if the company can grow the free cash flow, it could mean that the valuation is okay. But if they cannot grow the free cash flow in the future, I think it's not a good valuation right now. So it's not a check here. Now we're going to take a look at the balance sheet. We would like to see the debt to free cash flow ratio under 5. So this is very important because if a company has too much debt, it could risk to go bankrupt. We don't want to see that. So what we're going to do now is we're going to take the short-term debt, 35 million, and the long-term debt, 160 million. And then we're going to divide it with the free cash flow that we had, 604.9. So the number we're going to get is 0.32. So what does it mean? So the debt to free cash flow ratio means in how many years we can pay back the debt with our free cash flow. And we have here 0.32. So in under 1 year, we can pay back the debt with our free cash flow. This is a great number and we really like to see that. So it's a check here. We're also going to take a look at the cash on hand, and we can see here they have around 2.5 billion cash on hand, which is a great number actually. They have more cash on hand than debt. It's looking really great about the balance sheet actually. They can use this money to pay a dividend or to buy back their own shares. So this is really looking good. The next one we are looking for is shares outstanding decrease. This means the company buys back their own shares. So we like to see that, especially if we think the company is undervalued. So we're going to take a look here and we can see they did buy back shares in 2023 and their shares did decrease, but overall it didn't decrease in the last 5 years. We can see here 2024 the shares outstanding increase again, so we don't like to see that. We're going to take a quick look here as well, because we can see here the repurchase of preferred stock. Yeah, and we can see here they did buy back their own shares in 2023, around 500 million, but in the other years they did not, and actually the shares outstanding decreased. This can mean that it's have more shares outstanding, which can mean that the stock price decrease. So we don't really like to see that, especially they have a good amount cash on hand. They can use some of this money to buy back their own shares. I would like to give my conclusion about this company. So let's start with a positive. They have a revenue growth in the last 5 years. They have a free cash flow growth in the last 5 years. They have a good balance sheet, which means low amount of debt and a good amount of cash on hand, which they could use to pay dividend or to buy back their own shares or to invest in the business. So we like to see that. The negative would be low free cash flow yield. So the free cash flow yield is under 3%, which could indicate that the company is still overvalued right now. Even that the company dropped 24% in the 6 months, with the free cash flow yield under 3% is still looking not so good about it. What I also don't like is the shares outstanding increase, which means that they put more shares on the market to get money. And we need to see how they use this money. If they can really invest this money in the business and can grow the business in the future, then we like to see that. But we also saw that the revenue didn't increase that much. It was close to 10%. And I think we would like to see more about that, especially because the shares outstanding increase. So it means they get more money from shares. So they need to show better results, I would say. But overall, it's an interesting stock. If they can make more free cash flow in the future, I think this could be a value play right now.